While you were watching the stock market charts this week, the real decision was made behind closed doors in Basel, Switzerland. This is not rumor. It is a signed regulatory mandate from the Bank for International Settlements, the central bank for central banks, and it goes live the moment markets open on Monday. They quietly pulled the trigger on the final phase of Basel III. If there is money in a bank account, this touches it. Here is what changes. For decades, big banks treated paper contracts for gold and silver like the real thing. Unallocated gold meant a receipt without a bar in the vault. It let them sell promises and treat those promises as safe assets at almost no cost. That cheap setup enabled huge short positions and aggressive price suppression, especially in silver. Basel III rewires the financial plumbing by changing a core metric called the net stable funding ratio. This makes holding paper positions expensive. It penalizes short positions. Banks must either buy the real metal to back their bets or get out of the market. They passed this to prevent another 2008-style disaster, but in doing so, they lit a fuse. Giants like JP Morgan and Citi can no longer sit on billions in shorts without massive real capital. The cost to manipulate price just exploded. That is why positions are being unwound in the overnight markets. It is not hype, it is compliance. The buying pressure is the banks trying to survive the new rules before the Monday deadline. Here is the twist the headlines will skip. Gold is being reclassified. Yesterday, regulators treated gold like a risky asset. Starting Monday, gold is Tier 1. It sits next to cash and treasuries as risk-free capital on bank balance sheets. That flips incentives. Instead of dumping gold to suppress it, banks are now rewarded for hoarding it to strengthen their books. When the biggest sellers become the biggest buyers, the price floor hardens. There was a clue last week. That strange liquidity vacuum was not a glitch. Market makers stepped back. They pulled sell orders to avoid getting trapped when the new rules hit. Algorithms have been recalibrating for a world where physical metal is king, and the banks are not alone. Industrial heavyweights like Tesla and Samsung can read the same rulebook. If paper silver supply disappears, the real price must rise to meet real demand. Factories are scrambling to lock in supply, while banks chase the same bars to meet new requirements. There is not enough silver for both sides. Meanwhile, China's been playing this game differently. The Shanghai Gold Exchange only trades fully allocated physical metal. No paper tricks. By pushing Basel III, Western regulators are moving toward that model and admitting the paper system is dangerous. Physical is safety. This matters for everyday savings. Making banks safer by forcing real collateral comes with a cost. To buy gold and silver, banks sell something else. They sell dollars and treasuries. That means downward pressure on the dollar as metals revalue higher. When gold resets higher as Tier 1 capital, it is the mirror image of a weaker currency. That is the quiet tax on savings. There is also a specific warning. If metals are held in an unallocated account at a bank, those accounts become a liability under the new rules. Do not be shocked if a letter arrives saying a precious metals program is discontinued and the position is being cashed out. Banks need the metal for themselves. You will not hear about the net stable funding ratio on nightly news because it sounds boring. But this is the plumbing of the system. The era of paper leverage is ending, and the era of physical assets is opening. This shift is historic on the scale of 1971 when the gold window closed. Back then, the system moved away from metal. Basel III is a bureaucratic U-turn that moves it back toward metal, disguised as regulation. Central bankers know the debt strain is real. They are preparing lifeboats made of gold and silver. Expect chaos in the short term. Paper shorts will scramble and volatility will rip. The long-term trend is locked by mechanics. Price must rise until physical supply meets physical demand without paper dilution. That target sits well above $85. There is another side effect. If banks must carry more real capital, they lend less. Credit tightens, mortgages and business loans get harder to secure. That is deflationary at first, but the Federal Reserve will not allow a crash. The response is printing. Slowing growth plus more money is stagflation. In that weather, stocks and bonds are not the safe harbor. Silver has been the standout. Dig deeper and the London loophole just vanished. The LBMA allowed unallocated gold to count as high quality, which enabled leasing the same bar many times. Basel III deletes that trick. To be Tier 1, gold must be allocated and sitting in a vault. London banks now need real inventory. Fractional reserve gold is fading, and the pull on global vaults will accelerate. This reaches into derivatives too. The $100 trillion derivatives world rests on collateral quality. Better collateral is now required. That makes trading derivatives more expensive and triggers deleveraging. Hedge funds that relied on cheap leverage to short silver are in trouble. Banks will not extend easy credit for those trades, forcing exits and fueling a short squeeze driven by regulation, not just sentiment. Big capital has been early. Sovereign wealth funds in the Middle East and Asia prepared for this shift, front-running the rule change because a Tier 1 gold world needs higher gold to support balance sheets. A small allocation into silver from a $1 trillion fund can detonate the market. Basel III centers on gold, but silver wins by association. Historically, they move together. As gold is remonetized for institutions, silver reclaims its role for the public. The ratio tightens. There is a doom loop for banks. Many do not hold enough metal. Buying it drives the price up, which hurts existing short positions. Following the law damages their own books. That loop points to emergency support. The Fed likely has to print to help them buy, which is inflationary. All this unfolds while one camp pushes hard money and another pushes central bank digital currencies. In that tug of war, the individual can hold the one asset both sides want: physical metal. Auditors will be checking vaults, double counting and leased bars masquerading as owned inventory face exposure. Banks that cannot prove ownership will face shutdowns or bailouts. Demand for audit-proof bars will spike. Miners will sell straight to banks, bypassing the public and industry buyers. That squeezes supply for everyone else. The rule starts Monday. Full implementation will take years, but markets are time machines. Smart money is not waiting for 2026. By then, silver in triple digits is on the table. Regulators forced honesty, and that means higher prices for gold and silver. Banks are buying, nations are buying. The question is simple. In a world where the paper game is ending, are you positioned for the physical era?